Hello, it's been a while. Welcome back to the channel. Happy New Year to everyone here. I just came back from China and I'll be sharing a video on Chinese equities soon, maybe the next video after this. But for today's episode, I'll be covering something that is slightly different to the usual ones. I'll be covering my next most probable buy, which is Netflix over here. So this is a write-up that I'll be sharing soon on our Substack account. Feel free to check it out. It's the link in the description below. I'll be covering a few things. So the company and the industry overview, Netflix, Moat, the thesis surrounding the company, why the Warner Brother deal isn't actually as good as I initially thought, and my most probable entry level for Netflix stock. So the first portion over here will be on the company as well as the industry overview. So over here it says majority of Netflix business is tied to the subscription business model where users sign up for their Netflix streaming platform. Netflix business model is relatively easy to understand. They set a content budget every year and then what they do with this budget is they'll go and buy licenses or they'll create content on their own. So most companies in the SVOD industry, which is your streaming platform industry, operate on a very similar business model. The industry as a whole is a very competitive one. So not only is Netflix competing with other SVOD companies, it is also competing with companies outside of this space, like for example, YouTube, Twitch, and even Sleep. This is what the company has said. Specifically in the SVOD industry, there are a few key players. You have Netflix, you have Disney, you have Amazon, Paramount, as well as HBO Max. So we'll be discussing the big three players in the space and why Netflix stands out in this entire space here. So as you can see, Netflix holds a 8.3% market share as compared to Disney at around 4.7% and Prime Video at around 3.8%. This is accounting for all streaming services, not just SVOD. So of the three players, Netflix, Disney, and Amazon, Netflix is the only company that is focused on streaming. So Disney, you have your other businesses like theme parks, IP, they have the traditional filmmaking arm as well. So Disney has many different business models, similar for Amazon as well, where they have the Amazon Marketplace, they have AWS and so on. So Netflix is the only company that is solely focused on creating the best streaming platform, and that is why it is still currently the best. For streaming companies, the best measure of a quality streaming platform is in these two metrics here. Number one is your churn rate. So churn rate is the number of people that is cancelling the subscription. Second of all is the watch time per user. Basically, it's an engagement metric, similar to YouTube where you have your retention. On streaming platforms, watch time is one of the more important metrics that you should try and look out for. So in terms of churn rate, Netflix has structurally lower churn rate at around 2.1%, which is below the premium streaming average of around 4%. So this is despite all the price hikes that the company has done over the years. Disney's churn rate is closer to around 8%. Amazon's churn rate is relatively low, probably a lot lower than Disney's one, probably on par with Netflix, because Amazon Prime Video is often bundled up with the Amazon Prime subscription. So there's not really a reason for a user to try and cancel this Amazon Prime portion. So for watch time per user, this is the numbers over here. Netflix is closer to around 1,000 minutes per user in November of last year. You have Disney at around 851. Amazon Prime Video is closer to 600 plus. So as you can see over here, the engagement numbers for Netflix users is a lot stronger as compared to the other streaming platforms, along with the lower churn rate as well. So the divergence can be attributed to a few different reasons. The first reason is a comparison between Amazon's model as well as Disney and Netflix model. So the best words to describe this is utility versus feature. So Amazon Prime Video is often bundled up in the Amazon Prime subscription, and what that means is that it serves low intent users. So people are not actively searching for Amazon Prime, they're not actively trying to subscribe to Amazon Prime. They're using it because it's a feature in the entire Amazon Prime subscription. So it's for low intent users. On the other hand, Disney and Netflix, of course, they serve high intent customers that search for all these different platforms that are looking for streaming services, leading to higher engagement and potentially higher CPM numbers as well for ads, as well as lower churn and higher monetization efficiency measured by revenue per engaged minute. So as you can see over here, the revenue per engaged minute for all these different streaming platforms, Netflix is of course the highest one. So in the case of Netflix versus Disney, Netflix's strategy has been slightly different from Disney's one. They're not trying to focus on extending the franchises. Of course, if they're able to do so, they will do so. But in the case of Netflix, they have lesser IP as compared to Disney. So what they're trying to do is to focus on high volume content to reduce consumer churn, increasing reality TV show output to serve as fillers, to improve retention, and niching down on local markets to drive growth in domestic industries, with increased content spend over time. This is in contrast to Disney, which has reduced their content spend, so they used to spend a lot, now they're spending lesser, and has been a second mover in a lot of the strategies deployed by Netflix. Disney's focus is on extending the existing content IP, and what that leads to is content fatigue. So for example, on Disney, if you go on Disney Plus, there's a lot of Marvel shows, and then there's Marvel 2, Marvel 3, basically an extension of the original Marvel shows that they already have. And what that leads to is content fatigue. And besides that, of course, you have other different problems that Disney face as well, which leads to higher churn, which is poorer UI UX, aggressive bundling with Hulu as well as ESPN. So Disney and ESPN and Hulu are normally bundled together and pushed to the consumer. And this substantiates the point that Netflix has a more superior management team. On local content spend, Disney, for example, has forecasted around 24 billion for 2026, which is down from around 33 billion in 2022. So as we mentioned earlier, Disney is reducing their content spend. So around half of that is for licensing contracts for sports, with the other half allocated for entertainment. So with significant content spending required for its existing franchises, what that means is that Disney is spending a lot lesser on local content as compared to Netflix. And when you're able to spend more on local content, what that means is that it helps to push subscriber growth abroad outside of the US. So for example, over here, Netflix has around 70% of subscribers coming from outside of North America as compared to Disney at around 55%. So Netflix also targets a greater range of countries with over 50 countries as compared to Disney at around 20 plus. This proves Netflix dominance with greater reach, greater scale, dominating those local SVOD industries. To substantiate this point even further, the number of movies by Netflix is also a lot higher, with greater number of reality TV shows. So although Prime has a larger content library, as mentioned above, it serves low intent customers, leading to lower engagement numbers. So the platform has provided too many shows, and it is probably overwhelming for consumers. So as you can see over here, Netflix has around 3,800 movies as compared to Disney Plus at around 1,300. TV shows is also a lot higher than Disney Plus, which is the second player in the space. So there are, however, grounds to argue that Netflix is actually losing their dominance over time. So this is a counter argument to my initial argument of Netflix being super dominant. This is based on the Nelson's report. And as you can see over here, the number of shows that Netflix has had in the top 10 has been declining over the years. So Netflix is the one in bright red. It has gone from 80% in 2021 of the original shows to around 52% in last year, 2025. So fewer top 10 shows matters less as long as the company is able to hold its watch hours as well as retention numbers. So even with lesser major hits, Netflix's ability to generate basically less viral niche content helps to maintain its customer base and to reduce churn and maximize profitability. So it is best visualized this way. So you have your hits over here, they make up a substantial amount of profits, of course, but the low intent one is actually the one that is driving lower churn for the company. So the company doesn't have to have hits every single year that goes out to the entire public, as long as they're able to satisfy the local customer base, basically this portion over here, the long tail effect, then what that helps to do is it helps to reduce churn over time. Next portion, I'll be touching on Netflix Moat. So Netflix Moat is extremely simple. Number one, it's your data-driven flywheel effect. Number two is your content IP for the company. Number three, it's scale. And lastly, it is the brand for the company. So as you can see over here, this is Netflix. I don't know if you can see it, but Netflix is currently in 16th place in terms of the most valuable global brands. And the flywheel effects is over here. So more Netflix subscriber leads to better algorithms and data collection, leading to better recommendations, leading to better experiences, better engagement numbers, and lower churn. This is the flywheel effect for the company. Content IP wise, the greater content IP over time increases the value proposition for customers. So what that means is if you're paying, let's say, the same dollar amount for this Netflix subscription, you're getting more shows. And this is beneficial for customers over time. Next one is scale. So scale allows the company to basically reduce cost per user, cost per subscriber over time. So imagine if they're able to hold the content spend stable over the years. Let's say they spend 18 billion this year, 18 billion next year, 18 billion the following year. And if they're able to continually grow this subscriber number, what that means is that they will have lower content spend per subscriber. And besides that, the local content spend also works because it can travel internationally with scale. So this will help to drive operating leverage on the upside over time. Next one is brand. So as above, Netflix has the 16th most valuable brand based on Kantar brand ratings, ahead of Disney at 52nd place. So although Disney has their incredible content IP, it is still at 52nd place. So while not the highest quality business out there, Netflix is a company at its current trajectory, a great business. Next portion, I'll be going over Netflix Thesis, which is the most important portion of this entire write-up. So going over Netflix Thesis, I have two different theses that I would like to highlight. The first of it is this ad-tier subscription business model that the company is trying to push, which will drive growth for the company with revenue of ad-tier being 30% higher than the non-ad tier division based on my calculations, of course. So as highlighted in our previous Substack, based on all these different numbers over here, the ad tier expected CPM is at $13. Assuming a CPM of $20, this implies around a 30% increase in terms of revenue if customers transition from this non-ad tier to this ad tier division. So with the company having around 65% of new users already trying to sign up for this ad tier portion, what that means is that it will translate to strong revenue growth in the future. So in comparison, Disney is closer to around 50%, Amazon is closer to 80% because users are already automatically signed up for this ad tier division unless they opt out. Amazon actually has an advantage because what they can do with this ads portion is they can funnel their users towards their Amazon marketplace to drive greater reach, to drive greater growth for that portion of the business. Netflix has taken advantage of this. What the company is doing right now is they're selling its ad space through Amazon's demand side platform since late 2025. So as highlighted earlier, Netflix has greater engagement numbers, and through selling its ad space on Amazon's demand side platform, what this will help Netflix do is to effectively combine Amazon's reach with their ability to have greater, higher engagement numbers to drive up CPM even further. So evidence of strong ad growth is already present, with the company reportedly doubling ads-driven revenue. So with Wall Street expecting around 11 to 13% revenue growth over the next 2 years for Netflix, which is mostly in line with the S4 industry forecast. So if you were to blend all the S4 industry forecasts for the different regions, it is already around 11 to 13%. So what that means is that Wall Street isn't pricing in any of this ad tier growth that is present for the company. So there's potential for the company to beat these revenue figures with ads-driven growth. This is the first thesis for the company. Second thesis is that Netflix's existing content library is underappreciated, with growth that can extend well beyond the 4 years of their useful life. So what Netflix does is that it amortizes the content spend, around 90% of the content spend, within 4 years of the show being published. So for example, a 2021 show like Squid Game is mostly already fully amortized, although users are still watching it. So as you can see over here, around half of Netflix viewing time is actually from shows that were debuted before 2023. So based on a report released by Netflix for first half of 2025, here are some calculations. So Netflix originals that are more than 4 years old actually make up 15% of the total watch time across all shows. This is a lot higher than 2024, which is closer to around 8%. And this shows that their older titles are driving more and more watch time over the years. So as we said earlier, the company sets a useful life of around 4 years, but after the 4 years, the company is actually still generating watch time, substantial watch time, and hence revenue for the company, which will help to drive margin growth over time. So with 15% of watch time already coming from these older shows, this is material. It is similar to this other company called Universal Music Group. A lot of Universal Music Group's revenue is actually from music that is from many years ago. So as Netflix continually builds up this content library, what that means is that after all these shows are amortized, when it's off their balance sheet already, when it is not incurring any cost for the company is still able to generate growth from this portion of the business, which will help to drive revenue over time. And there is also an optionality with this because older shows have the ability to blow up suddenly with the forces of TikTok, with the forces of YouTube Shorts today. So I'm sure you guys have seen a lot of shows popping up on TikTok, all those older shows. If one of those older shows blow up, it will also help to drive watch time for Netflix. And similar to the argument earlier, if all these shows are already amortized, this will help to drive watch time, free watch time for the company with no cost. So the counter to that would be if older shows take up a spot on the homepage that could have gone to a new hit that drives new subscriptions, are the older shows purely profitable? So while this argument is plausible, Netflix content library is still substantially smaller than its competitor, like for example Amazon. So showing that there is still ample room for content library growth. As long as the company is able to use the data to drive recommendations, having older shows set in the library isn't actually a bad thing, as long as they don't show up on the recommendations for a user to take up space in the user's recommendation. So the library thesis works as long as Netflix continues expanding total hours, not just reallocating them to older shows. So on the Warner Brothers Discovery deal, this is what the company is working out. So the company is paying around $27.75 for each share of Warner Brothers Discovery, and they're paying an equity value of around $72 billion and an enterprise value of $82.7 billion. The difference between enterprise value and equity value is that your equity value is your market cap, your enterprise value is your equity value plus net debt. So what they're doing is they're buying Warner Brothers Discovery for $72 billion, and they're also bringing in around $10.7 billion of debt on top of this. So working out the numbers, the current debt to EBITDA is around 1.25 times, and Netflix net debt right now is around $7.76 billion. So working out all the numbers over here, they need to raise around $60 billion in order for them to pay for the deal. And besides that, they're also bringing in around $10.7 billion of debt from Warner Brothers Discovery. So what that means is that the company will be actually trading the debt to EBITDA of around 6.1 times, assuming the deal goes through. This is quite the leverage from the company. So I'm not a fan of mergers and acquisitions, but it is important for you to weigh the benefits to the potential increase in terms of interest expense that the company has to bear. And these are my conclusions here. So interest expense will be around $3.5 billion. Warner Brothers unlevered free cash flow is around $2.5 billion. So what that means is that the company has to find a way to try and cover this $1 billion hole that they'll be incurring over time. So Netflix is guided for around $2 billion to $3 billion of cost savings by year 3. So what that means is that the company is positive in turning this $1 billion hole into additional free cash flow for the company by year 3. So for the first 2 years, this acquisition will be negative for free cash flow for the firm. Cost synergies will likely come from G&A expenses as well as infrastructure consolidations, with potential content budget reductions, although those are higher risk. So quantitatively, it is a net neutral to a negative. Qualitatively, however, this deal allows Netflix to gain access to Warner Brothers Discovery massive library. So they own Harry Potter, they own DC, which is your Batman and so on. And they have HBO classics as well, like for example, Euphoria. That's one of the hit shows from a few years ago. So they are essentially paying for content assets that would otherwise have been incurred. By buying Warner Brothers Discovery library, they are acquiring tier 1 IP with proven residual value, allowing the company to reduce the need to be venture capitalists and to bet on new content and to try and make sure they go viral. So if the company is able to have its cost savings put into place, as well as allow Warner Brothers Discovery HBO Max to continue growing, I think it could turn out being a positive for the company, although I'm skeptical. It is a bit different from my initial view because the gearing is a lot higher than what it is today. So overall for the deal, I think it is net neutral to slightly negative for the firm, simply because of the fact that the company is having a lot more gearing as compared to what it is today. Last portion, I'll be covering my potential entry into the stock. So I'm actually looking at an entry of around $85 a share, which is around a 30 times EV to EBITDA ratio. So while that 30 times may be a bit expensive, this initial buy will likely be a starter position. So given different gearing ratios as well as their content spend and amortization expenses, I'm using EV to EBITDA. So Spotify is currently trading at an EV to EBITDA of around 47 times. YouTube is currently at around 22 times based on Barron's estimate. This was what they did a few months ago when Google was down in the waters. So Netflix has a bit of both. So they have the YouTube arm, which is the advertising model. They have Spotify's arm as well, which is the subscription model. So blending those two together, I've taken a middle point estimate, and based on these two numbers over here, it's around 35 times. So at around 30 times, I think it's reasonable for a company like Netflix, which is projected to grow at around 26%, 27% over the next 2 years. And with the forward P estimate of around 26 times, I think it is reasonable. And that's why I'm looking for an entry into Netflix. And yeah, that's all for my Netflix thesis. Hopefully the stock reaches this strike price. I'll be selling a put around $85 a share, which will bring my average down to around $83 if the strike price is hit. I hope you guys have found this video useful. In the next video, I'll be covering more on China, and I'll see you soon.